Thanks for joining us for the Notional Live Community AMA. We're happy to have you all here, and we'll be posting this on YouTube, on our YouTube channel as well, afterwards. But while we wait for a few people to join us, I'll introduce the team, talk about a little bit what we're gonna be discussing today, go over some key numbers from the last quarter, and then we'll get started with some of the questions and topics we're going to cover today. So with us today, we have our CTO, Jeff Wu. We have CEO, Teddy Woodward. And we have our quantitative analyst, Pierre Yves, aka PY. So let me just get started with a few numbers from our recent Q2 report. If you want to find the full summary, you can head over to our blog. It's blog.notional.finance, and you'll see that just a few posts down. So a few numbers to start with. We're really excited to share that we crossed over the $500 million mark in total loan volume since the V2 relaunch in November of last year. So this is a great milestone for us, as it's one of the key indicators of how we see that there's actual protocol usage happening, which is really what we want. This is really multiples higher in the fixed rate loan volume than any of the other fixed rate protocols out there. So again, we're really excited to see that figure. And not only that, but in Q2 alone, we had about 125 million in loan volume. So I know it's sort of an interesting time in the crypto market, of course. So even though TVL is down across basically every project in DeFi right now, we haven't really seen that translate into actual lower usage levels at this point. So that's really great to see. And then just a quick note on some of the rates and yields possible on Notional at the moment, just for quick reference. Of course, these change at any moment based on usage, but right now for LP, for liquidity providers, we've got ETH at about 5%, Wrap Bitcoin 8%, DAI and USDC right around 10%. Our note staking module, we have that APY right now, it's about 44%. So if you've got note tokens, there's no real reason not to go ahead and stake them in the balancer module. And for lending and borrowing, you can lend DAI for a year at about 5% right now, and lend or borrow USDC for any of the 3-month, 6-month, or 1-year durations from about 2.5% to 3% right now. All right, so let's go ahead and get started. I want to bring in PY first. So as our resident analyst right now, and obviously this has been an interesting market, a lot of volatility. PY, can you kind of walk us through what types of risk that Notional faces during these kind of extreme market volatility times, and maybe talk a little bit about how Notional fared on each of those measures? Yeah. And I think PY's got some video issues, but his audio's all good.
Sure. Hey everyone, very happy to be on the call. So forgive me if my voice is not great. I've been feeling a bit sick for the past couple of days, so sorry about that. So yeah, I'll just go over how Notional performed from a risk perspective over the last few months and highlight the main risks that the protocol faced and how it mitigates these risks. So at a high level, one thing that I think has been pretty interesting to see is that over a period of time where ETH and Bitcoin prices decreased by more than 50%, and where you've seen USD implode and multiple funds blowing up or defaulting, DeFi protocols like Notional were able to remain solvent at all times and prove to be extremely resilient. And maybe to talk more about how Notional works and why it was able to perform so well during these times. So Notional is an over-collateralized lending protocol, meaning that borrowers must always deposit collateral assets that are worth more than their debts in the system. And as a consequence of adopting this over-collateralized framework, the main risk that the protocol faces is price risk. So basically, price risk is the risk that the value of collateral assets or debts in the system change over time. And in order to mitigate that risk, we enforce minimum collateral ratios for borrowers. And these minimum, if any borrower breaches these minimum collateral ratios, their account would become eligible for liquidation. So just going back to what happened in Q2, so as like ETH and Bitcoin prices went down, a few notional accounts actually breached their minimum collateral ratio requirements. And as that happened, we've seen multiple liquidators competing to liquidate these risky accounts. We've seen 20 liquidation transactions where liquidators liquidated like for a total of $1.4 million in collateral assets. And by liquidating these risky accounts, liquidators made roughly $70,000 in profit, while contributing to making sure that Notional was sufficiently capitalized at all times. So in short, like liquidations worked exactly as expected, and we're really happy with how the protocol performed on that front. Another thing we're really happy about is how Notional handled withdrawals over the recent months. So just to give you an example, on the day that USDT pegged, we've seen LPs redeem more than $100 million from Notional without any issues. And just to put that in context, at that time, it represented more than 50% of the total end token liquidity in the system. So although it's never fun, of course, to see users withdraw their liquidity from the protocol, it still highlighted that like Notional was able to process large withdrawals just as intended, while remaining liquid at all times. So yeah, I think like the recent events really highlighted like the value proposition of real DeFi protocols versus like CeFi. We've seen like DeFi protocols be extremely transparent at all times, and also managing their risk in a very predictable and orderly way. And although unfortunate, the market drawdown was a good stress test for Notional. And we're extremely happy with the fact that the protocol performed exactly as intended. And the risk management will continue to be our top priority, and especially as we roll out new products like the results and as we add additional assets on the platform. So yeah, that's pretty much it from me.
So one other question I kind of we've talked a bit about and heard from the community is like, why there was the drama with the Solana and the Solind protocol that they had the whale on the protocol that they had issues liquidating. Why is that not an issue, or will it not be an issue again in the future for Notional?
Right, so that was like mostly a liquidity issue, basically on Solana. So on Notional, we only list like very high quality assets, such that we're like very confident that we can like liquidate these assets like on the market, like on chain. So that's like how we basically prevent against such a case. Like we don't allow people to put like too much collateral, like too much of an asset in collateral on Notional. And then we make sure that there's always like sufficient liquidity on chain to make sure that we can like liquidate these assets if needed. And that's like something that maybe other protocols are not doing or monitoring as much as we do. But yeah, that's how we kind of prevent against that, basically.
Okay, yeah, that makes sense. Yeah, so I guess, yeah, moving on a little bit to Teddy, if you want to just, maybe talk a little bit more about the general meltdown in the world of the CeFi businesses that we've seen with like Celsius, of course, and then also the contagion from 3AC. Like, what do you think the implications of it are for Notional in the near term, and also just like the general DeFi ecosystem?
So I think, like kind of echoing what PY had said, what we've seen in the last few months is really a validation of what we're trying to do at Notional and kind of the value proposition for DeFi as a whole. I think that, it's been a big stress test, and we've seen that like that like all the DeFi lending protocols came through very well, and the centralized protocol, like centralized companies, had a lot of trouble. So, in one sense, I think that there's been some amount of recognition of that fact by the broader market. I think that I think that that's good, and that like bodes well for DeFi in the future. I do think that, you know, it's been kind of surprising what's happened. You know, because basically, like, so, like, DeFi hasn't seen an influx in usage or funds, and I think that that's. So I think that like the market consequences are interesting because, like, on the one hand, you know, there's a lot of money that's like sitting in DeFi protocols that's earning very little relative to what can be earned in CeFi, and you know, I think that you know, perhaps that is sort of like a tacit recognition of the fact that, you know, DeFi protocols are seen as less risky. But like what you haven't seen is, you know, borrowers like coming over from CeFi to DeFi, which I think has been kind of, I don't know if it's been surprising. I guess because, you know, a lot of the biggest DeFi borrowers are actually the companies that went insolvent. So in some senses, I guess it shouldn't be surprising. But like a consequence of that is that what you've seen is the spreads between DeFi rates and CeFi rates have widened dramatically. Because basically what's happened is there's been like a massive contraction in credit in CeFi. So very few people are willing to make loans, and there's still all these people that want to borrow. And so the lending rates in CeFi have gone up dramatically. And at the same time, the people who've been borrowing on DeFi have all, well, not all of them, but many of them have gone insolvent and have had to close their loans out. So DeFi rates have gone down and CeFi rates have gone up, right? Which is just like, and now there's just this huge gap. And, you know, I don't expect that to persist forever, but it's certainly an opportunity. And yeah, I'm not sure how that gap will be closed, but I do think it will sort of over time. Yeah.
Who do you see that as an opportunity for, if you see an opportunity there? Or what do you see the opportunity being?
Well, I'm basically like, if you're a lending business, you know, I don't know why you wouldn't borrow on these, borrow in DeFi and lend in CeFi. To me, it seems just obvious. You know, I think like, I think some people are doing that. They're not doing it in enough size to close the gap. I think there's like a lot of, that trade has a lot more capacity than the amount of capital that's like willing to do it. Yeah. And so I think that, you know, kind of, you know, some of the reason why people aren't is potentially regulatory uncertainty, or they're like scared. And then there's also just like, people are just generally quite like, a lot of people are still very uncomfortable with DeFi protocols. And like, you know, the companies that were the most comfortable, like Celsius and Exo, again, like, are no longer using DeFi because, well, at least Celsius is bankrupt, right? And so I think that like there's like a tremendous opportunity for, you know, some centralized lending business who's able to sort of plug into the demand in that market to like utilize the spare capacity in DeFi. Yeah, and I expect that to happen at some point. Yeah.
Okay. Yeah, that's really interesting. Let's talk to Jeff a little bit as well. Jeff, so as CTO, you know what's going on behind the scenes. Everyone says bear markets are for building, but of course we are always building. And we know you're hard at work. So can you give a little update of kind of what's been going on the last couple quarters, and maybe just in the near future as well, what we can expect to see?
Yeah, absolutely. So, as many people know, we launched Notional V2 in November of last year. So it's been live for a little over, you know, half a year now. The first quarter that, you know, we were live, obviously, it was, you know, a lot of improvements, a lot of responding to feedback from people around the UI, and we had like a bundle of sort of like, you can think of them as like fixes for the incentive kind of distribution early on, and a few other sort of like improvements that we saw in response to like how the protocol is being actively used. The other major thing we did in Q1 was launch note staking, this stake note module. So we launched that in mid-March. Early April, we were still sort of like working on setting up treasury management and ensuring that like we could execute the buybacks through that. And so that program is still ongoing. And that's sort of the source of that 44% yield that you get for staking note. We've also, since launch, we've been working with a lot of other protocols on integrations with Notional. And this has kind of been like a very like part of the job that I really enjoy and like quite interesting and enjoyable to work with developers from other protocols. So, you know, today we've worked with Fiat DAO, Yield Protocol, Yearn, Index Co-op, Contango. So these are all protocols that are building on top of Notional and using like Notional capabilities, you know, for kind of a variety of reasons and for their protocols. From that, we've learned a lot just about like things that are hard to do on Notional, things that can be improved. And so from all those learnings, we launched the Fcash wrapper, which went live a couple weeks ago. That, you know, turns Fcash from an ERC1155 token into an ERC20 token, and furthermore also adds this ERC4626, which is sort of like a generic yield-bearing token standard that you know that Yearn and many of the other kind of top protocols are keen on using. So, you know, and we've also added a number of capabilities that make sort of just interacting with Notional from a developer experience, a smart contract developer experience, much better. And you know, these were things that we knew before launch that we would have to do, but it's sort of like, it's always better to get the actual feedback and just like build exactly what you know, what those people need and kind of like have those insights in hand. So that was a big focus for us this last quarter. You know, the other thing that we run, you know, the other thing that we kind of manage beyond just the kind of core protocol is also liquidation bots, as PY had kind of talked about earlier. And so this last quarter, we've also, you know, improved our liquidation bots to be more efficient, you know, and we've also kind of started to see MEV competition against those bots. So that's sort of liquidators who are pretty aggressive and able to sort of front run our bots in order to win liquidation opportunities. Now, this is like good and bad. It's sort of cut into like, you know, the Notional Inc. sort of liquidation profits, but we also see this as a good thing for protocol stability, right? Like we know for a fact now that there are multiple kind of liquidation bots out there, sort of ensuring the stability of the protocol. So that, you know, that we see as like a really strong indicator that, you know, people are taking Notional seriously and looking to build on top of it. So Teddy's going to go into leverage vaults a lot more here. But that has been a big focus of ours on the development side this last quarter. So we're currently in audit for the core components of that of this kind of new module, this like kind of major upgrade to the Notional system. That's currently in audit with consensus diligence. So there's a lot of work that went into that the past few months. Both like designing the strategy, testing it, you know, writing the code. This quarter, mainly we'll be working on continued testing for the different leverage vault strategies, upgrading our liquidation infrastructure to make sure that it can handle that. And we'll be doing sort of like due diligence on new strategies as they become available. You know, like DeFi is like constantly changing landscape, and sort of hoping to be in place for like a kind of like a mainnet launch for that later this quarter or early next quarter. So that's just like continue work there. On the smart contract side, we're like thinking about like the next set of kind of core protocol improvements we need to make past leverage vaults. So like from I guess from a protocol development side, we're always thinking 1 or 2 quarters ahead of where we are now. So specifying, you know, like what do we want to do in like what do we want to have available in late Q4, late Q3. We've already had 3 audits this year, so we're hoping to have 1 or 2 more audits for new functionality before the end of the year. So a lot of planning goes into that. And you know, so that's all on the smart contract side. And then furthermore, the other thing we do in addition to the smart contracts and liquidations is we like host this website, the Notional web app. So while like I think, you know, in the last quarter, we haven't really seen much of the UI like look and feel change. A lot has changed under the hood to make it more reliable and robust. So we're going to start to see the benefits of that this quarter. We've also launched like a survey on the site to get more feedback just around like website usability. How do people feel about it? And we've gotten a lot of great feedback there. And so we're working on like a complete overhaul of the portfolio page to make it more intuitive, to make sort of different actions that you can take on your portfolio easier to find, easier to use, and a host of other improvements like the ability to support multiple networks, internationalization, notifications, and just kind of make sure that our kind of the design language and like the kind of app code sort of scales really well as we add new capabilities like leverage vaults. We want to make sure the UI like continues to be really clean, like really efficient for people. And so, you know, so there's like a host of like things that we're going to redesign and improve. And, you know, my hope is like we start to see that kind of roll out to the main site, you know, in the next 6 weeks or so. So a lot to look forward to there. Yeah.
Sounds good. Okay. And then I have to ask you the main question we get from the community all the time, of course, is L2. What is the like general thinking on L2 strategies and the, you know, coming down the line?
So L2, I think, you know, I guess the way we think about L2 is it's not just a technology problem. Certainly, like, you know, like on Polygon, we could easily kind of deploy Notional there, and you know, if the website can support it, you know, users can start to use it. The main thing that differs, like makes Notional different from something like Aave or Compound, is that there needs to be enough liquidity for people to lend and borrow on the different markets. And so we want to make sure that we do this in a way that doesn't really harm, not just like the tech, like more of the economic experience of using Notional. And so our thinking to date has been that, you know, Notional V2 on mainnet still, you know, we're still building there. You know, we're still adding new functionality like leverage vaults. There's additional things that we think can be improved with the L1 implementation. And so we want to get that to like a really solid place, and then think about how we want to extend that into L2. And, you know, I think there's a naive way of doing that. And that naive way of like just deploying it again may be the right thing to do. But I do think that we haven't really spent enough time like considering like alternatives, right? And like different ways of deploying onto L2 and getting people sort of kind of getting people the economic experience that like the best possible economic experience that they can get. One thing I do want to call out is that like we're also seeing like L2 technology evolve very rapidly. So, you know, like ZK EVM, Aztec, and ZK Sync, these protocols are doing kind of new and interesting things that, you know, that may kind of, and I think Polygon ZK EVM also is launched. So like the L2 environment is also moving and evolving very rapidly. So we do kind of want to make sure that when we go into L2, we sort of like catch the right kind of experience and catch the right technology to kind of deploy onto. I think we've seen with like DYDX, right, that went live on Strikeware. They since decided to go to Cosmos and do something different. So, I think, it's just something, like everything we do in Notional here is like, we try to be as thoughtful as we can as we do it. So it's just, I think, another thing that we want to like put the right amount of time and thinking and effort into it and do the right thing when it's the right time to do it. So, fortunately, that does mean like gas costs are a problem and do price people out. That's something we're, aware of. But we also want to make sure that whatever we do is like the right product. So, yeah.
Yep. I think that makes sense. We got to utilize the resources we have in the right, most efficient way possible. Great. So we do have one question from the audience. So we'll get to that. That from our Discord. If you guys aren't in our Discord yet, you can go to discord.notional.finance and join the community there. You can also comment on this Twitter and we'll try to get to it. But basically, it segues nice into, I think, what Teddy is going to talk about next. So he's just asking, over the next 12 months, what will be the main driver of Notional's adoption? Talk a little bit about sort of the launch of the next Notional product, which I think is what you believe will be the next driver. So yeah, take it away, Teddy.
Sure. So first of all, 12 months is a long time in DeFi. I'll just say that right off the bat. But I think that I do think that sort of levered vaults, the kind of the next product that we're offering, is going to be a big driver of growth for Notional. And I can explain, what levered vaults are and why I think that's true. So first of all, I'll give some background on what the levered vaults product is. Now we've spoken about this a little bit in our forum, and a blog post is upcoming. So we'll get that out in the next few weeks just to give some more details on what this product is. But basically, we've built a framework that will allow users to obtain leverage from Notional with minimal collateral, and users will be able to borrow from Notional and deposit the cash that they borrow in a whitelisted smart contract, so in a vault that is going to execute a specific strategy. And so you'll be able to, one of the strategies that we're going to launch with is in ETH strategy, where you're going to take your ETH, deposit it into the balancer ETH wrap staked ETH liquidity pool, and then potentially take those LP tokens, stake them on Aura, and harvest the rewards that you get. Right. So this user is going to be borrowing ETH and deploying into that strategy. Now, what makes this really powerful is that that strategy might return 12% APY. And the current rate to borrow ETH is on Notional is something like 3 or 4%. So basically, a user is going to be able to get something like 5 times leverage on their capital and borrow ETH at 4%, put it into the strategy, and earn 12%. Right. So that's like an 8% spread on 5 times leverage. So if you calculate the APY on their initial capital, it's something that's really, really large. It's like 40% or something like that. Right. And so what we think this is going to do is drive borrowing demand and increase the interest rates on Notional in sort of all of our currencies, or at least all the currencies with active levered vaults. And I think that this is going to drive a significant amount of usage and adoption of Notional for a few reasons. So basically, I think that there's going to be a lot of interest to use this product itself. And then I think that like it will drive a lot of lending volume as well. So what we have found over the last, however long Notional's been live, so something like 8 months or something now, is that basically as long as you can offer like a decent yield, people will lend. And ultimately, the main driver of usage is borrowing volume, right? Sourcing the capital to lend on Notional when rates are high is not hard. I mean, everything takes work, but we've already like done a lot of that work by integrating with other protocols like Yearn who lend on Notional, right? So we've sort of like done a lot of the work necessary to like make sure that if we do have like decent yields available on Notional, capital will be able to come in and take advantage of those yields. So really, it's like borrowing drives usage. The more we get to borrow, the higher our rates go, and the more lenders we can get as a result of that. So I think these levered vaults are going to drive a lot of borrowing volume, increase our rates, make our rates more competitive than any other lending protocol, any other sort of like safe lending protocol in DeFi, because this functionality is unique to Notional. And I think that, even beyond that, these levered vaults are going to be a really great tool for integrating with other protocols and providing sort of unique capabilities within their ecosystem. So I think that this is going to be just a really big driver of growth for Notional in terms of borrowing on the currencies we have today, as well as like enabling us to list other currencies that we don't currently have on the platform and doing something unique. So I think this is going to be a big driver of growth. And then just looking at the questions here. So the main barrier to entry for users, I would say that we haven't really nailed down the numbers here, but I think that the minimum deposit size is going to be relatively large on these vaults. And the reason for that is we need to ensure that the vaults can be profitably liquidated. And the gas costs for liquidating a vault position is pretty high. So we need to be sure that there's like a big enough position in the vault such that a liquidator can profitably liquidate. And that in turn means that, we're going to have to enforce minimum deposit sizes for users. So I think that's going to be potentially a barrier to entry for some users, number one. The other thing is that this is a sophisticated product, right? Like this is something that's quite new in DeFi. And anytime you introduce leverage, anytime you introduce borrowing into a trading strategy, you increase the risk of the strategy and you also just make it more complicated, right? So in order to effectively use this product, people need to have kind of a deeper understanding of what they're doing and what the strategy itself does. Now I think that this is like a very powerful tool, but it is most effectively used with, some amount of sophistication that goes beyond just straight up lending on Notional, right? Just lending fixed on Notional is a very simple experience. You know exactly the rate you're getting. That's that. And this is something which is a little bit more complicated. Again, the returns that you can get using this product are potentially a lot higher, but the trade-off, right, is that there's some amount of risk and sophistication involved. Yeah.
What is the sort of risk in the liquidation sense? Is it different from borrowing just generally at a fixed rate, or is it a different situation that can arise that would require liquidation?
Yeah, so it's different in some ways. It's the same in other ways. So whenever you talk about liquidation, it's because you've put down some collateral and you've borrowed something and the value of your collateral falls, right? So on Notional today, it's like I'm putting down ETH, I'm borrowing USDC, I can get liquidated if the price of ETH goes down, right? Now, in the context of a levered vault, your collateral is the strategy itself. it's the value of the assets in the strategy. So the same principle applies, right? Like you've borrowed some amount of money against some assets that are sitting in a strategy. And if the value of those assets decreases below a minimum threshold, you can be liquidated. So in that sense, it's the same thing. What makes it different is that like, maybe it's sort of like more like the reasons why there's more like it's less straightforward why the value of the assets in the strategy falls, because like the asset is doing something more complicated than just being ETH, right? Yeah.
So yeah, I think that makes a lot of sense. So what is the competitive advantage that Notional has in launching this product? Like I know there's some other vault products out there in DeFi, but why is it going to be different with levered vaults on Notional?
Yep. So first of all, I think it's two real competitive advantages here. So I don't think there are many sort of vault products where you're able to get leverage from a lending protocol. I think there's maybe one or two, so that's one advantage. And then I think the second advantage, which is pretty key to Notional and quite unique, is that you're getting the rate you're paying on your debt, the rate you're paying on your leverage is a fixed rate, and it's pretty low. And I think that the fixed rate here is really, really important, because basically, like when you enter into one of these levered vaults, it's not a position that you're going to want to get out of in a couple days. Like generally, you're going to want to hold it for some period of time. And because you're working on leverage, where like the difference that you're earning, so the difference between what the strategy is earning and what you're paying on your debt is relatively small. Being able to fix the rate that you pay massively reduces your risk, right? Because if you're let's say like let's say you're doing one of these levered vaults and the strategy is earning 8% and the rate you're paying on your debt is 6%, your profit margin is 2%, right? Is like pretty slim. Now you're able to earn, as the user, you're able to earn a higher return on your capital because you're levering it, right? Because you're using leverage. Now the thing is, like the flip side is that if the rate you pay on your debt exceeds what you earn on the strategy, you can end up like losing money. And like, because you're using leverage, you can lose potentially a lot of money. And so if you're borrowing at a variable rate, the risk that happens is quite high, right? And the ability to fix the rate means that that like the rate on your debt isn't going to increase. So all you have to worry about is what you're earning on the strategy. So it like massively de-risks the proposition. And I think it's a pretty unique competitive advantage that no one else is going to be able to have.
Awesome. Yeah, I think that makes a lot of sense. One other question that I got, and I think that leads us to kind of our final topic, is like why is more vault? You talk about this levered vault product being sort of a flywheel for encouraging more borrowing, which should raise rates, which will increase the lending activity. Why is more volume on the protocol good, just in general, and good for like, note holders, maybe note stakers? And then like how does the introduction of this product kind of lend itself towards Notional's overall like profitability and long-term sustainability as we kind of go into this extended bear market environment?
Yep. So anytime that a user lends or borrows on Notional, they pay a transaction fee, and that transaction fee is split between liquidity providers and the protocol itself. So these levered vaults are going to drive increased transaction volumes, and thus will drive increased transaction fee accrual, right? And so what that's going to mean is that the protocol is going to make more money, and that liquidity providers are going to make more money. And that's great, because it means that it will allow us, this like levered vol product will allow us to reduce, or will allow Notional to reduce its sort of dependency on providing note incentives for liquidity providers. Because because as there's more transaction volume, there's more fees accrued, and the sort of organic return to providing liquidity on Notional increases, right? So we no longer need to incentivize as much. So it's good in that respect. It is a big step towards getting the protocol to a place where it's sustainable in the sense that like we don't have to pay people to provide liquidity. And then, on the other side, the protocol is going to be earning greater fees, right? Which, means that we won't. So it means that like there's going to be more value accrued for note holders, as well as like, the protocol will be less likely to have to sell tokens in the future to raise money to continue development. So the more money that the protocol makes means that like kind of the less note supply will be hitting the market in the future, and just generally means that the protocol is in like a healthier position to fund development and growth and all that stuff.
Okay. I think that makes a lot of sense. Do you want to talk about any like specific figures for goals or numbers you want to hit with the levered vaults product, or leave that for a future blog post?
I think I might leave that for a future blog post. I think at the moment it's we hope to have kind of more concrete numbers as we get closer to launch. Yeah.
All right, cool. And maybe just like a rough timeline for when we expect to see this product. I know there's, I guess it's an audit right now, but general expectations.
Yep. I think it's going to depend on the results of this audit and how the next few months go. Now we're hoping to get this product out by the start of next quarter. That's the target at this point, which is just over sort of 2 months away. So that's where we're targeting currently.
All right. Excellent. I think we've covered all the topics we had wanted to. We've covered all the questions that have come in. Of course, if you're interested in getting to know more about Notional, hop into our Discord at any time. We're always available to answer questions. Our DMs on Twitter are always open. And come join the community and check out the fixed rates that are on offer and everything that's going on. Once again, I'll just say thank you to our CEO, Teddy, CTO, Jeff, and our analyst, PY, for joining me today and having a chat. And we'll talk to you guys soon, I guess.